This is part 2 of how to pay for college. Last lesson, we talked about financial aid, FAFSA, scholarships, and working during college to afford paying for it. Your last resort to pay for college should be loans. Loans are just like any other type of debt. You're borrowing money that will need to be paid back later and will collect interest over time. Depending on the loan amount and type, paying off a loan could take more than 20 years. In today's lesson, we will go over 3 student loans, subsidized, unsubsidized, and private loans, and an alternative to student loans, the income share agreement. The first option is a direct subsidized loan. These loans are offered based on the needs of the student, and interest is paid by the government while you're still in school. Once you leave school or drop below a set number of credits, you will have a 6-month grace period where the government will continue to pay the interest. However, interest will start to accrue after that grace period. The second option is a federal unsubsidized loan. This loan starts to accrue interest as soon as the school receives the funds. However, you will not need to pay back these loans until after you graduate or stop taking classes. Interest will continue to accrue your entire college career and will need to be paid back. Both of these loans can be accessed through FAFSA. However, there is a limit on how much money you can pay and get per year. This loan is capped at how much the cost of tuition is, minus any other aid you are receiving, along with fixed interest rates, which are generally higher and can include additional fees. For example, for a 5% interest loan on $30,000 paid over 10 years, an individual will pay almost $318.20 per month. This adds up to almost $8,000 in interest over the year. This means an extra $8,000 that you end up paying. The third option is a private loan. This loan may have much higher interest rates and will have their own agreements depending on the lender. These loans should not be taken out unless absolutely necessary. These loans are more like personal loans and will depend on the credit history of whoever is borrowing the funds. The last alternative is an income share agreement, or an ISA. In an ISA, a lender will give you money in exchange for a percentage of your future earnings for a fixed number of years. While an ISA may seem appealing at first, you can't repay early, and in some cases, you may end up paying more than the loan itself. While you may not be paying interest and you're only paying a percentage of your income, the amount you pay grows as you earn more. Additionally, while the name may not say it, the ISA is still a type of loan and you are incurring debt. Also, make sure your parents know about the American Opportunity Tax Credits. You may be eligible for up to $2,500 in tax credits for every child in college. This is money that does not have to be paid back. To conclude, there are a lot of ways to pay for college, and loans should be your last resort.